Hi everyone, it's Faisal here from Sheriff CPA. It's been a while, but I'm back. Today, what I wanted to discuss was the high price of holding one of these, and I'll let you know exactly what that means. What this means is if I live outside the US, I am still required to file taxes and pay taxes in the US. Yeah, you heard that right. Even if you are living in a foreign country, you are still required to pay taxes in the US. There's 295 countries in the world. Out of those countries, only two of them require their citizens to file taxes in their country, regardless of where they're living in the world. And the US happens to be one of them. Even if you have zero income in the US and zero assets, you still need to pay taxes in the US. Now, you're not completely out of luck. There's a couple of ways that you can help reduce or maybe eliminate your income by a couple of different ways. Number one, it's called a foreign earned income exclusion. And you can use this. It's only available for earned income. It doesn't apply to passive or investment income or interest or dividends or anything like that. But you can use this, and it's up to $120,000 of income that you can exclude. But it's not automatic. You have to file a Form 2555 in order to get that credit. So if you're living abroad and you've got earned income, you can use the foreign earned income exclusion to help offset your taxes, your U.S. taxes. Number two, this is called the foreign tax credit. And what this is that the amount of tax that you've paid in a foreign country, you are able to offset that with your US taxes. So, for example, let's say your foreign tax that you've paid in a different country, you're paying $500 in foreign taxes in a different country, and your U.S. taxes are 1,500. Well, then you're able to offset that, and you're only going to pay 1,000 for the U.S. taxes. Now, the only thing is you can't double dip. So you can't take the foreign earned income exclusion and the foreign tax credit on the same income. Now, if it's for different ones, then yeah, you can use both forms and get the deduction both ways, but it has to be for different sources of income. The foreign tax credit form, it's not automatic either, and it's form 1116. Now, the key is you have to decide which one gives you the most tax benefit, the exclusion or the credit, right? And there's a couple of factors you have to consider. So, one is if your foreign tax rate is higher than your US tax rate, then the foreign tax credit might be more worth it. Number two, if you want to participate in an IRA, then the foreign tax credit may be better for you. And then you can't exclude, passive and investment income on the exclusion. So these are all factors you have to consider. You got to do the math and see which one is more advantageous for you. At the end of the day, these credits are not automatic. You're going to have to talk to your tax professional and let them know, and you have to meet the criteria. And if you do, then you have to fill out the right forms in order for you to qualify and reduce or eliminate your US income by the amount. But that's all I got for today, guys. Thank you so much. I hope you enjoyed this video and you learned a little bit more about the high price of holding this beautiful passport, which nobody really wants to give up because it's worth more than you think. Thank you so much. Bye-bye.